Carl, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, trading this pivotal week ahead. Mega cap earnings, the Fed decision, jobs report, all looming large. The investment committee on the case as always. Joining me for the hour, Joe Terranova, Steve Weiss, Jim LEBENTHAL. Joe, we begin with records. We know that S&P and NASDAQ just continue to extend them. And the Dow's not that far away either. We're at 44.9. You see it right there. We need to get to 45.073 for an intraday record, and then we can 45.014 for a close. So we're not that far away. And we do have all this stuff ahead of us this week. How do you size it all up?
I look at today's price action, and I think it's consistent with a market that's somewhat exhausted, a little bit tired. I would have expected a more positive response, a little bit more of a breakout, a little bit more breadth in the market. You're not really seeing that right now. So here we go, coming into a critical week. Meta, Microsoft, Amazon, Apple, mega cap earnings. We know about that. I don't think you get much from the jobs report or from the Fed meeting, but can those mega cap earnings lift and extend this market even further? I am acknowledging the fact that it feels exhausted to me. I'm not necessarily sure you could do very much with that comment that it feels exhausted, because I'm not saying sell out of your positions, because ultimately, if we enter a correction, it's really a pause that refreshes. I think more than anything else, it's just set your expectation. Don't be an aggressive buyer up here.
Exhaustion implies something more dramatic than a rest. Like, why would you expect anything different today, I guess is my point. Yeah. Well, ahead of everything that we just laid out, what's the market going to make a big move before it gets the earnings, before it hears from the Jay Powell, and before it gets the jobs report?
Listen, you had the news, take it for what it's worth, over the weekend with the EU and a trade deal there. The futures last night were a lot higher. It looked like the indication was that global equity buyers were there. They were willing to participate, and that's kind of petered out early in the trading session today. You don't have the broadening out thesis. You don't have the participation from the Russell. So when I use the word exhaustion and you suggest that it could mean something deeper, yeah, I think you could easily fall.
Well, if you're exhausted, you need to go to sleep for a while. If you're just resting, you can get up, you can take a power nap, and you can get up when you get
the expectation.
Clarity.
Look, I'm not coming on air right now with the S&P at 6,400 and saying I want to be an aggressive buyer up here. I'm just being very.
I hear you.
You have to be very measured, and you have to acknowledge when it appears as though the market is getting a little tired and might need to pull back.
Well, because it doesn't really know what the impact of all of these tariffs is going to be. What is a deal in rhetoric is a tax in practice. And you might not find out the ramifications of any of that for months to come. So the market doesn't really know what to make of that. The bias is still higher, wouldn't you suggest? The trend is still up, and maybe the events of this week give you some more confirmation as to why that remains the case.
Yeah, no, I agree. I agree with what Joe said in terms of there's really no bull case for deploying capital here in the short term. But I agree with you. I don't think the market's necessarily exhausting at what's going on. You've got a big, heavy news week, and you just don't know how it's going to turn out. So I think if you take the probability that of two events, one being jobs, be somewhat of a non-event unless it's wildly one way or the other versus consensus. FOMC, they're where they are. Sure, you may get some more talk in the minutes that'll eventually come out about let's go. But frankly, the economy's operating fine at these rates.
Yeah.
So what's the big variable, if you handicap it, the most likely to occur? And I think it's possibly that with all the price target increases we're seeing, including today on the three that are going to report.
Well, Meta buy 775, B of A. Apple reiterated buy 275, Amazon target 271, Microsoft target 650. That's what you're referring to.
Exactly. So the market's really been, for all the talk of broadening out, this is where it is, right? So if those disappoint, or if they significantly raise CapEx, not a minor raise in CapEx, then you could see the market come under pressure. The odds of the market exploding to the upside for better than expected earnings, given that's already been pulled forward, I think is unlikely.
No, but
so that's the biggest variable.
What may be hanging in the balance more than anything else, and why the market could be resting, you can term it however you want, that's totally fine, is because it needs more confirmation that a broadening can actually happen. like you get it this week. You get a the full combination of everything. You get the mega cap earnings. Do you get more confirmation? I don't know why you wouldn't. That's the trade that's going to continue to run. And do you also, in the same breath, get confirmation that you could have a broadening? Because, depending on what Powell says this week, and depending on what the jobs report is, you could feel more confident about the direction of interest rates and economic growth in general.
I think there's a lot of news coming out this week, Scott, and I think most of it, we have a solid expectation of what's going to happen. Like you just mentioned, the Fed. We have a solid expectation of what the Fed is going to do. Two things. It's not going to raise rates, and it's highly likely to telegraph that September is likely to be when they resume rate cuts. Now, it's debatable, but again, there's a higher confidence that that's what they're going to do as opposed to not. When we're talking about the mega cap earnings coming up this week, I feel that Alphabet was a pretty good tell that both the numbers themselves are going to be good and the CapEx expectations are going to be raised. I don't think that anybody, say, a Meta can now say, oh, I'm not going to match Alphabet. That's crazy. This is a race for the biggest prize ever in corporate history. So nobody's going to say, oh, I think I'll just sit by the sidelines and let Alphabet spend away. With regards to trade deals, we can sit there and say, hey, we haven't done Canada and Mexico yet. We've still got to do China. But the indications are clear where the direction is going. It's tariffs rates in the mid-teens, and that should be sufficient enough to offset the cost and the deficit terms of the budget bill without cratering the economy. Now, what this all sums up to me, and I'm just going to take what Steve and Joe just said and phrase it slightly differently, the market has climbed the wall of worry. When I wake up today, I look at myself and I say, what am I expecting? The only thing that can come in that's a surprise is a negative, that somehow those deals with Canada, Mexico, and China don't come through, or that for some wild reason, which I completely don't expect, the other mega cap tech stocks this week disappoint. I don't think they will. I think that Joe's right. I don't really know the difference between exhaustion and rest, but what I will say this, seasonally, this is the time of year where weird stuff happens. I ask everybody to look back a year ago where we had a sudden sell-off because of the yen carry unwind, which nobody was thinking about. It came, it passed. We might have some unknown like that, but it is likely to be small, not even a full correction. That's my opinion.
Let me frame it this way. I'm advising caution here. So you mentioned Alphabet. What was the price response to Alphabet's earnings? Which I agree with you. The earnings was strong. The price response hasn't been anything spectacular. We're basically running in the same place. That might be the judicial issue that's coming up with a judicial ruling in August. I'm not really going to disagree with you. I was pretty happy with Alphabet. It had a pretty strong run into the number.
No, but he's not talking. Hold on. He's not talking about the run into the number. He's talking about the run on the numbers.
Okay.
The move wasn't much of a move. I think that's the point that he's making.
He and I are in agreement that this is a market that's ready for a pause. I think that's the wrong idiosyncratic case to take. But why don't you keep going, because I want to hear where you're going.
But if you look at it, it's not idiosyncratic. If you look at the move,
that's endemic of the market.
If you want to go the moves into the prints, my gosh, these stocks have crushed it over the last 3 months. Alphabet is one of the worst performers of the group over the last 3 months into the print, and it still didn't have a great reaction on the other side of it. I mean, Microsoft's up 31% in 3 months. Meta's up 31% over the same time period. Amazon's 25%, and then you start getting
we're violently agreeing that this is a tired market. We can phrase it any way we want. Tired, in need of a rest, exhausted, has climbed the wall of worry. This is a market that is due for a consolidation, not a correction, a consolidation. Joe, 5 to 7%, fine. In terms of the broadening, I do want to say this, all right? The equal weight S&P 500 is 1.7 percentage points away year to date from the S&P 500. And if you look back in 2024, 2023, it was close to 10 percentage points behind at this time each year. This is a market that has been broadening. Yes, it's true that mega cap has done very well, but if you look at a lot of other sectors, communications, industrials, financials, a lot of other sectors have done well, even materials of all things.
What you're talking about is how Google, Alphabet performed afterwards. That's endemic of the market. That's why we're not seeing, we don't know what the substance of this trade agreement is with the EU, but if you'd gone
We don't know the substance, frankly, of many of the deals
of any of them, actually,
that have been announced. If anything, the most positive thing to come out of it is just taking that specific thing off the card.
Right, but my point is that if it had been 2-3 months ago, you would have seen the market have a much bigger move. So it's been endemic of the market. What's really the hallmark of this market is the pull through. So we pulled through on the earnings, and referencing your comments on the other mega cap performance. That's why I said earlier, unless you see something big one way or the other, the stocks aren't going to do much. So the market's just anticipated all this, which goes to your conversation about the valuation levels. You need a lot more really, really good, unexpected news to get the market.
Well,
higher.
Canaccord today says that valuation is the stickiest wicket.
Yep.
In their words. It is the biggest headwind in this market. It's not earnings. It's not anything else. It is valuation. The earnings yield on the S&P 500 of 4.15% remains marginally below the 10-year at 4.38. And we note that this condition of a negative equity risk premium has not occurred since 2001.
Scott, we should not be expecting multiple expansion, trading at 21 times calendar year 2026 estimates. What we should be looking for is those estimates to rise, which they have started to do. After going down all year, they are higher now than they were 3 months ago. Next year's earnings, $300 a share. That's the macro estimate, the aggregate estimate from FactSet. It was $298 just 3 months ago. And as the results keep coming in from the second quarter, I think we're going to see those full year estimates for next year creep up, where 21 is not the actual multiple that we're looking at.
I think you have to remember sentiment and positioning are in a much different place than they were 6 to 8 weeks ago, for sure. Sentiment is overtly bullish. Positioning is overtly bullish.
I don't know. Overtly is another questionable word. I mean, do you really feel that way? Tom Lee continues to come on the network and suggest this is still a hated V-shaped recovery.
Skeptical
that institutional investors are not fully invested in the market.
I've been hearing
that's
that.
factual,
I've been hearing that for
but it's
a decade
factual
now.
that it's factual that you still don't have full buy-in from institutional investors and hedge funds. You
hedge
don't.
funds know, but hedge funds have missed everything. They're hedge funds because they're hedged, so they never. So rarely are they going to have exposure, net long exposure, 100% or 90%.
Sure,
or
but I don't
80%.
even know necessarily if long onlys have fully committed.
Long onlys aren't the asset allocators, so they've got to.
The point is that I would take issue with using the word overtly bullish. The feeling that I get and the people that we talk to is there's still a healthy dose of skepticism, not overt bullishness.
I don't know about that.
I think they're overtly whining. Okay, because they are participating, the market is going higher, and their deployment of their capital is what it should be along their guidelines.
I think I'm seeing a lot of reversal in that skepticism. I think I'm seeing a lot of speculation in places of the market that get me a little bit uncomfortable. And again, I want to emphasize this doesn't mean
retail
I'm bearish.
activity. I mean, okay, let's go there. Let's talk about the speculative trade, because remember, Goldman had the note out the other day that we brought up to you. Quote, the recent rise in speculative trading activity signals near-term upside risk for the broad equity market. They also say that it increases the risk of an eventual downturn. We bring it up today again because, AppLovin reiterated outperform. The ARK Innovation Fund, ARKK, up 36% year to date. Weiss, I'm not sure that we've gotten your full view on this run that we've had in lower quality and highly speculative parts of the market, and whether that's something to be concerned about, because if that leg of this four-legged chair, not Jim's three-legged stool that he tried to introduce in the same part of the conversation last week, to which I repudiated that immediately. If that leg breaks, the chair becomes unstable.
Yeah, and that typically is a sign that the quality is maxed out in valuation, and then when the lower quality, we used to say junk, starts to rise, it's searching for performance because you've missed what's above. So it is a little bit troubling, but I also continue to believe that this is a market that just doesn't look at valuation as we used to collectively. It's sort of like it's a side conversation. It's what strategists talk about because they've been involved in it for a long time. But it's really agnostic. It's momentum fundamentals and momentum of price that drives the market.
Because you can't just make a blanket statement anymore, given the mega caps and the outsized weighting that they have and where their valuations are relative to the equal weight S&P 500. You can't make a blanket statement anymore and say the market's overvalued, because people will come right back at you and say, well, 6 stocks are maybe richly valued or more valued than all this 493 where they're still undervalued.
There is some, but I take a look, for example, what Caterpillar's done, and I own Caterpillar, and Caterpillar's done very well. I think Caterpillar's fairly valued. So sure, you're always going to find stocks, companies that you can buy that are discount, but overall, you know, and I don't want to say they're that way for a reason. I don't believe in the efficient market theory that you have basically Vanguard and all the others. So there's always values, but when you take a look at where most of the capital goes, where the institutional portfolios go, I think you're pretty much fully valued.
Oppenheimer raises the year-end target on the S&P today to 7,100 from 5,950. So we blew past the 5,950. 7,100.
Yeah.
People would take that from here.
That's
right at 6,400.
That's a heck of a finish to the year. I believe to get there, you would have to have the broadening out. You mentioned the valuation on the S&P. The valuation on the equal-weighted S&P is somewhere around 18 times, which is far more reasonable than that. I also think.
Why do you need the broadening out to get there?
Because I just don't know if you're going to get a further multiple expansion from those 7 stocks.
Isn't that what this week is all about? That's in part what we're going to learn.
In the near term, yeah. I think in the near term it is. But again, I don't know if you're going to see today. And I looked last week. Again, it's my individual opinion. The price action in Alphabet, the earnings were phenomenal. The reaction to it, and there's a classic example, in my opinion, of a equity name. There was built-in skepticism. Myself and others had that skepticism. Jimmy, I know you took the other side of that. Congratulations, and you were rewarded for it. But I don't think you saw the type of price action that you should have been on the other side of that. And I think you could get very strong earnings this week. I think you could get further price appreciation, but I think you're going to run into the ceiling at a certain point, and I'm just urging cautiousness. Also understand, market structure has changed. 2025 is about momentum. You mentioned AppLovin, okay? The ETF owns AppLovin from $76. I've never once come on this network and said, we own AppLovin for some fundamental reason. It's a $120 billion market cap. It's the largest company not in the S&P 500. And on the fundamental side, there are a lot of challenges in front of it. You have the Muddy Waters allegations. I'll let Muddy Waters and AppLovin's management deal with that. But I've never said it's been the fundamentals that's driving it forward. It's all about momentum.
So how do you deem it quality? Your ETF is about two things.
Completely.
Quality and momentum.
Absolutely, Scott. The momentum completely overwhelms the quality factor. So if you take a composite score on momentum and then you take the composite score on quality, it's almost as if the quality score would have to be so detrimental to weaken the strength of the momentum score. You take a company like AppLovin.
On the fundamentals of this company.
AppLovin or Palantir. No, I said I've never come on the air and said it is the fundamentals, the reason that we own this stock. I've never defended the fundamentals. I'm not questioning the fundamentals. I'm taking the fundamentals. I'm putting them over there for the analyst community to look at. I'm saying the reasoning behind us owning the stock has purely been momentum, and it has been a stock that has rewarded us in that regard because the momentum has been so strong, and it's indicative of the market.
But if you don't think that it meets the quality metric, then you've increased your own risk profile in this particular name, because momentum, as we know, can reverse it at any moment.
Absolutely it can, and there have been times that this stock actually has reversed its momentum. Remember, it was a $500+ stock in February, and I think post-earnings it fell from there. It's had a little bit of a bounce. We'll see as we move through the course of time and we measure the different time frames of momentum where the momentum score rests for this company. But I'm telling you that in the last 12 months, there is maybe Palantir. There's no other individual name we own that has a higher momentum score.
Okay. JP Morgan's trading desk has a note out today pointing to the fact that the S&P has rallied more than 25% over the past 75 days. That is the largest 75-day rally since the rebound from the COVID lows. Forward-looking returns after a rally like this are quite strong. A year later, the index was higher every single time, with an average return of around 20%. I mean, that's why you start getting Weiss big numbers thrown around of where some think this market can go.
Yeah, I once, a few years ago, I looked at this because I was, I kept hearing, well, the market was up 25% last year. It was up 30%. Can't possibly be up another 25 or 30. And that's actually not what history tells you. When the market's had a big move, that it typically does have another big move 2 years following. Last year was a good year, but you shouldn't attempt to judge the future by saying we've had such a big move. It all depends on it depends really on what the negatives are out there and what the wall of worry builds up to with new events than it does, because the path of least resistance is always higher.
Pasquarello today, the core directional bias is to be long U.S. equities, that both professionals and civilians will remain sponsors of stocks.
Yeah, but let me just add this point real quick. But that's where you always get slipped up, and you can't predict when you're getting slipped up, because there's always this exogenous event that comes along, and that's what really catches you. But you can't guard against that. You just can't do it.
Well, if you were afraid of that, you'd never invest in anything.
Exactly my point. Exactly.
I totally agree with what you just said. It's what I was trying to say earlier about, remember last summer, a completely unexpected exogenous event, the yen carry unwind. Who knows? Who knows what will happen in August? But what I've been doing and what you can do, you've heard me say many times, I don't market time. I want to stay fully invested. But what I have done, and I've talked about this over the last several weeks, is I've trimmed a few of my winners. Oracle, JP Morgan. Scott, I know we want to talk about Cheniere later. I'll just simply say that I trimmed it last week. What I've done is, instead of recycling that immediately into some stocks that I love but maybe haven't done as well, is I'm just waiting. I'm just taking my time. Now, I haven't built a huge cash position. It's about 5%. I might take it to 7%. Anything higher than that, you're getting into market timing, and it's dangerous. But to have a little bit of dry powder for Steve, what you just said, I think this is what you just said, everybody's piling on in the positive.
I feel like you're trying, in a sense, though, to talk out of both sides of your mouth. Like, you are timing. You're trying to time the market because, as you said at the top of the program, and you threw it out like, I feel like a little cavalier, 5 to 7% pullback, no big whoop. 5 to 7% from where we are now would be a little bit painful.
It'd be a little bit painful, but guess what? You don't invest unless you have pain. I'll hear you. There is a little bit of talking out of both sides of my mouth,
okay.
But consider the numbers.
Acknowledge that.
No, well, listen, I got to live in the real world. We all do. Let me just go through the numbers. Let's just say that the market goes up 10% from here, and I have 5% cash. I've lost 0.5% in terms of relative performance. If I did something nutty like say, I think I'll do 25% cash, that's a much bigger underperformance. What I'm saying to you is I'm willing to take that very small underperformance of risk to have a little bit of dry powder if something goes wrong and be able to pounce. You know what I hate? You know what I really hate? Is two things. One, writing stocks up and down, and then at the bottom saying, I'm selling something that's got crushed to buy something else that's got crushed. I don't like it. I'm not going to do it.
All right. We'll take a break.
Okay.
Right?
Let's do it.
I'm not ready to take a break. I want to keep going.
Do you have something to say about his talking out of both sides of his mouth?
We're going to have to take a break then.
No, let's do it before the break.
Yeah.
We still have some time.
Look at the gleam in his eye.
I haven't been yelled at yet in my ear. We have time.
I will say equivocating is a valuable tool for some people on the desk.
Live in the real world. I am. I'm not saying anybody isn't. Don't go nuts here. Live in the real world. We've got to make decisions. I'm making decisions. I'll live by that.
He's making decisions not to make decisions.
No,
and I applaud
am.
that.
I made decisions to trim winners. I will live with the ramifications if I'm wrong. And you know who will keep my feet to the fire? You and you and you. And I live with it. I'm fine with it.
I have no intention of touching his feet like ever. You know, you guys can do that.
All right. I'm not being yelled at, but I'm being urged to go.
Yes, sir.
All right. We'll do our calls of the day next. All right, welcome back. Calls of the day. We go to one of Jim's favorites. It's Adobe. The target trimmed to 430 from 465. Reiterated outperform at Wolf and at Lebenthal.
Yeah,
You still
I'm
on
on my. Yeah, I know. I'm on my last nerve with this stock. I mean, it's. The company's operational performance has been fine. The stock's performance has been absolutely lousy. I'm giving it one more earnings report. That's it. I mean, look, they're going
to fix everything in one earnings report?
No, it's not. It's not that there's something that they need to fix.
It's like after
They're getting cannibalized by AI.
No, they're not, Joe. I know that. Sorry, I don't mean to get so uproarious with you.
Please can. It's allowed in this courtroom.
That would be the conclusion from the stock price reaction.
That was uproarious for you. That was uproarious.
Yeah.
Go ahead.
Carry on.
All right, look, it's actually not. That's what the thing is the stock keeps reacting like, well, the next quarter they're going to get their lunch eaten by whomever. It's not happening quarter after quarter. But what's also not happening is the stock isn't getting any respect. This is not a hill I want to die on. One more quarterly report. It either responds positively or I'm done.
Okay.
You've got revenue growth that's now down to somewhere around 10%.
Yeah.
Look in front of me.
Go ahead.
This was a company that had revenue growth 20, 25%.
Yeah.
3, 4, 5 years ago prior. Why the significant deceleration in revenue? Where's it coming from?
Well, it's a bigger company. I mean, you ever heard of a PDF, portable document format? Ever heard of it? I mean, you know, the law of large numbers. I'm just having some fun with you. Don't get quirky with me.
Go ahead.
The law of large numbers says that eventually growth rates tap out a little bit, but it's still growing at, I think, and it's at
You're
an 18.
blaming the decline. No, come on.
It's an 18 times multiple. It's reflecting a 10% growth rate.
Objection, Your Honor.
Yes, sir.
Sustained. You're blaming the decline in revenue growth on the fact that it's a bigger company than when? When? Than 10 years ago?
Then
He's
2
not
years
talking
ago,
about 10
then
years
5
ago.
years ago. Every company faces declining growth rates. What's the growth rate of NVIDIA right now versus 2 years ago? I mean, 2 years ago, we were talking about NVIDIA doubling earnings every year. Now we're down to 40%. This is just what happens. You don't
40%
grow
is all
at
you have to show to keep multiple. But look, this is squarely in the sights of AI. And we've seen some replication or some duplication of what they do in terms of the PDF. So right now there's uncertainty. And this is where complacency did come in, because you still have, while it's an 18 multiple, which is traditionally is very, very cheap for this company, we just don't know where it shakes out with AI.
What does a 2-year chart look like on that? Can we have a look? What's the return over 2 years?
1 year, it's down 31%. Let's look at 2 years.
What's the 2-year return?
Down 30%.
Okay, so it's down 30% in 2 years.
Yeah.
We literally are in the throes of the largest technological advancement in humankind, the way we're going to live, work, and do everything else theoretically, since the birth of the internet, right? Much of the gain for those stocks has taken place in the last 2 years. The stock's down 30% in 2 years. What do you know that the market doesn't know over the last 2 years?
That the multiple has come down all of that time because the company has actually shown good operational performance. The share price hasn't reflected. I mean, these are two facts. That's why the multiple has come down. Another quasi-fact is that one more earnings report, and I'm done with this if it doesn't respond. Look, the long-term earnings growth projection on this stock is 13%.
I'm not trying to talk you into selling a stock here.
No.
I was just trying to talk you into defending something
what I can't
again and again and again and again, where maybe the writing's on the wall.
Yeah, and you might be right. What I can't defend and what I can't predict is how the share price will respond to good results. And frankly, that's what any manager of any company that's worth investing in should say, is I'm going to focus on running my business the most profitable way and the most growth-oriented way that I can, but what I can't control is the share price.
When was the last time you bought more of this stock?
Within the last 3 months. I know I announce everything I do on air. I know I've bought it in the last 3 months.
That's why I'm asking.
I know it's.
I feel like on the earnings conference call, the analysts, the first question is going to be, how are you going to defend and compete against AI? To my point, Steve's
but that's been the call on every single call.
Right, but you're saying it doesn't
still
matter.
An overhang.
It does.
Look, the primary target of the internet turned out to be retail, right? Really dislocated retail. It made a lot of what were winners into losers, and it's never been the same. The primary target of AI is software. There will be some winners. We don't even know who they will be at this point. But a lot of what's being done now through an Adobe and through others will be able to be done internally.
I'm looking for other. We've given Jim a lot of business here.
Do we have time for another call of the day?
I'm looking for one that we could give Joe some business on.
Okay.
What's Arista Networks done? Targets 137. It was 103. Buy at Melius. I don't have the performance in front of me. Has Arista Networks done good? Has it done well?
What are you looking at? 1 year, it's up 44%.
Okay.
You want year to date?
All right.
It's up 4%.
All right. Year to date up 4%?
It's up 4%. It is participating in AI, data center build out. Obviously, there's a strong need for networking. I would acknowledge that Jimmy's Cisco. Jimmy, I'm going to butter you up here.
Why are you trying to deflect?
Well, I'm not deflecting. I'm acknowledging Cisco's up 14% year to date.
No, you deflected.
So Cisco has a little bit more of a market presence in networking and benefiting in the data center build out. But Arista Network, it's working there as well. They report earnings on August 5th. We've owned it for quite some time in the ETF. It's done well for us.
Okay. We'll do ETF Edge next. Reporting within the next 24 hours. It is a much bigger week than just the mega caps. Spotify is tomorrow morning. Joe?
Up 50%, 56% year to date. Digital streaming, audio streaming is very strong right now. I think the most interesting thing about this company is the fact that their competition has focus elsewhere. So it's Apple and Amazon. Apple and Amazon not necessarily spending so much to grow their audio streaming platform right now. So they're in a good position. You've had a 10% pullback here in the month of July, which gives you an opportunity to get back into a company if you're not in yet, which I believe over the long term is going to continue to build upon its streaming growth.
The Hartford Insurance is today after the bell.
Insurance has not been particularly good in this earnings season, in particular for property and casualty. We're seeing catastrophic losses are higher. I'm going to be careful here with my words, but for sure the insurance companies that we own in the ETF are somewhat momentum challenged in the near term.
So the ones you own are a little suspect.
Momentum challenged.
All right. He has to be careful. I don't want to get him in any more trouble.
Wednesday we rebalance.
I do, but I really don't. AstraZeneca. Before the bell, tomorrow. Jimmy, that's you.
Yeah, I expect decent earnings. I don't think this is a stock that really moves on the earnings releases. It's really when fervor comes back to the pharmaceutical space. Like many pharmaceuticals, this is a very cheap stock at 15 times forward earnings, 2.1% dividend yield. But it has a very wide array of therapies that it treats. It's got a good pipeline. So I can't really say, Scott, that the earnings are going to kill it tomorrow. I don't think they'll disappoint. It's just a long, slow burner for me.
P&G is tomorrow, Joe?
Down 6% year to date. I think, Steve, they're eating the tariff costs. I think that's exactly what's going on, what the challenge is right now for this company and the reason why it's down year to date. A lot of people like to point towards interest rates and say you need lower interest rates for consumer staples to work. No, I don't think it's that. I think it's margin compression directly related to eating the cost on tariffs.
Yeah, I mean, staples aren't exactly in favor either. I mean, maybe it has a lot to do with that.
And people are trying to determine the reasoning. Is it interest rate related? Potentially, yes. But I think it's more about a lot of these companies are incurring the cost of the tariff, and that is leading to margin compression.
Okay, but I was going to suggest
products.
that money's going to comm services, it's going to financials, it's going to tech, it's going to utilities because of AI, and it's going to industrials.
I would agree with that. That's a fair statement. I'm also...
Tariffs haven't even been in place that long for company.
Procter & Gamble rolled over in March.
Okay.
The beginning stages of what we were preparing for with the tariffs. In early March, we knew that tariffs were going to be coming in the next 30 days, and that's when Procter & Gamble and some of these other companies rolled over.
Okay, Royal Caribbean. That's tomorrow as well.
Benefiting from not just the domestic consumer, but the global consumer, which has remained remarkably strong, and also a fantastic turnaround in the balance sheet. Think about where this company was 5 years ago.
Okay, Weiss, United Health. Now it's time to give you the business. Tomorrow before the bell. What's your defense of this one now?
I'm not defending it. I have no idea what they're going to do.
But you own it. That means you bought more of it. So then
do own it.
You're a de facto defender of it through your actions.
Fortunately, it wasn't a huge position, and unfortunately, it's gotten
I'm armed with everything.
It's a fair desk.
You can try to deflect.
No, look, I have no idea.
Easy over there, Bob Hope. Let's get back to the story.
Your allergy to fashion is unbecoming. Look, I would. I don't know. I would hope, and my thought is that they will set the bar very low. The federal lawsuit is going to go on for a long time, and ultimately they'll settle, and it won't impact the company.
But you don't think the stock's in the penalty box during that period?
I think partially, but it doesn't mean it can't go up. If they set the bar low enough, and it's already set pretty low by the share price, then I think the stock could move higher. It becomes a good trade. So could it go past 300, which is, I got it in about 304? Sure, it can. But it won't be tomorrow. It's not going to be one day.
Okay.
And the overhang will stay there.
All right, we'll take a quick break. We'll come back. All right, we'll do finals in just a moment. But we do have a move. Mr. Weiss, you're back in Uber again.
I am.
Tell me more.
Look, I think they've got definitely the pole position in autonomous and robo-taxis, much more so than Tesla. They've got the right cost profile because they're not picking up the cost. Waymo is. So I think they'll do quite well in the earnings because even though prices have gone up, you know, from what I'm hearing, demand hasn't suffered. So it all adds up to put up a good quarter.
Okay. Thanks for the update. What a year, up more than 50%. What's your final trade?
Taiwan
while we're
Semi.
at it?
When you're going to hear about the CapEx schedules, Taiwan Semi is the one that plays. The president of Taiwan had delayed his trip. That won't matter.
Okay. Farmer Jim.
Wynn Resorts, 4 successively higher highs this year. It's 1% away from the 52-week high, and then it breaks out from there.
All right, Joe T.
Like buying the refiners here, especially as we come into hurricane season. You got the price of oil muted in the mid-60s.
All right, good stuff. Thanks, everybody. Exchange begins now.
Hey, I'm George with Blue Cloud Trading, and that was Jim Lebenthal, Steve Weiss, and Joe Terranova on the halftime report earlier today. It's Monday, July 28th. It's currently 5:02 p.m. And what we're going to do in this video, folks, let me share with you what's going to happen. We're going to go over the index ETFs here. We're going to take a look at the heat map, which is important to see which specific stocks in the S&P 500 look good, as well as the index ETFs. We're going to do the technical analysis here. We'll take a look at about 14 stocks and ETFs that were discussed on the show. That list right there. I've actually highlighted the strongest ones with a little blue flag at the top, so make it a little easier to recognize, as well as 3 of the Mag 7 stocks like Tesla, Apple, Meta. We're going to do all that in this video. So yeah, I'm not covering all the stocks that they talked about, but a good chunk of them. And all right, let's get started. Let's look at the markets, guys, and see how they performed today. Well, it was kind of mixed, obviously. You can see here that the Dow was down 0.14. It actually started up. Basically, it opened around the same closing price as Friday, dropped, came back above, and you can see then it basically broke. Once it broke that little low there, it just dropped a little bit further. So it was down 0.14%. The NASDAQ, on the other hand, it actually gapped up. You can see that right there. But then throughout the day, it actually dropped. And then what you'll see is a trend line break towards the end of the day. A little bit of buying took place, and it ended up 0.33%. The S&P 500 did something similar where it gapped up, and then it started making a series of lower highs and lower lows. But then, as you can see here, it also broke that trend line right there at the end. So that's positive for the NASDAQ and the S&P 500. It was only up 0.02%, the S&P 500. And then the Russell 2000, it actually, gapped up in the morning and then dropped and basically stayed around this level, down 0.12%. Let's look at the heat map now and see how the individual stocks did. And here we have, Tesla up 3.02%. The semiconductor stocks did really well. You can see that right there. What didn't do well is healthcare stocks. Okay, the financials didn't do so well today, but energy stocks were up quite a bit. Walmart was up just slightly. You can see real estate, utilities took a hit today. Industrials were pretty mixed. And then let's look at the individual sectors here. You can see that energy was the top performer for today, up 0.91%. Technology next by up 0.55%, and then consumer cyclical. And then real estate, basic materials, consumer defensives, and utilities were all down more than 1%. Here's the 1 week performance. All right, let's get into these ETFs. We're going to start off with the index ETFs, and then we'll get into the stocks talked about on the show. So we've got the S&P 500 still in a nice steady uptrend. It's almost like we've been lullified into this nice, beautiful uptrend. The question is, will we have an event coming up very soon? And the answer is yes, on August 1st, this Friday. And that's when we find out what the impact of the tariffs, globally are going to be. What countries are going to be hit? And if it becomes a problem, then obviously the markets could potentially drop. And so it's not a bad idea on Friday to start thinking about hedging, and that's one of the things I teach members who become members how to hedge on my channel. So, and that's using inverse ETFs, for example. Okay, that's my strategy for hedging the stock market. and how to go about that, basically. Okay, so here's the S&P 500, still looking pretty strong. Let's go to the next one, QQQ ETF. Also a very strong uptrend. We're using the Ichimoku indicator. What we're looking for essentially is for the price to just be above. You can see the price here above the Tenkan-sen, the Kijun-sen. That's the 9 period. That's the 26 period. You want price to be above the cloud itself. Okay, right there. That's the single span A. That's the single span B. And if you look, what's interesting about this indicator, it projects into the future, 26 periods into the future. We also have the Chiku span right there. That is the white line, and that's the closing price projected 26 periods ago in a line form. And you want to see where that is in relation to the candle 26 periods ago. If that white line is above, that's very bullish. Over here, in the past, you'll see that the Chiku span was under. It didn't really do so well for the market, but once it cleared that area, then we saw some strength occur, and the Qs started to move up. All right, next we're going to look at the Dow. Dow Jones down 0.15%, but it's kind of stuck in this little range here. Nothing important happening here. Still under the 451 level. I would not be touching this until this price breaks through, and conclusively too. Russell 2000 also doing something similar. It's kind of just stagnant and also building a base right there, right above the Tenkan-sen. It's got support, resistance of 230.70 right above it. So I wouldn't do anything here with the Russell until it can clear that level. That's just my take on it. The VIX is still, it was up 0.67%, but it's still in very healthy levels of like around 15, which is where we want it to be. But just remember that the VIX can also spike very quickly. Just a day or two can go up quite a bit, and it can change the outlook of the market. Here we were in April, for example, with the initial, tariff announcement that led to that big spike. And so, with the, with the information that we're going to find out on Friday, we could potentially get another spike like that. So just giving you guys a heads up. FEZ, the Euro Stocks 50 ETF, this one dropped down 1.94%. So it was looking pretty bullish here on Friday. We could see that price was in fact above the moving averages on Friday, but then it actually gapped down in the morning and then closed inside the cloud, but technically right above the Kijun-sen, where it's found support in the past multiple times, as you can see there. So nothing to do here with FEZ except for it's more of a hold position. IBIT is it popped right back above the Tenkan-sen, but notice how it's holding right under that trend line, so I wouldn't be that excited about that. It is good that it was up 1.12% though. All right, let's go to the next section here, the CNBC stocks discussed. Now, the strongest ones are up here at the top. There's like 6 stocks and ETFs here. Let's take a look at RSP. That's the S&P 500 equal weight ETF. Very strong uptrend on the daily and on the weekly chart. Okay, very bullish. ARC Innovation ETF. It's getting a little bit toppy here on the weekly chart. It's had its run. I think that I'd be, wouldn't be jumping into this one. It's still very strong though on the daily, and technically, it's above the levels that we want it to be, but it's just a bit far, from our equilibrium levels, which is between the Tenkan-sen and Kijun-sen. So it's got a long way to hit support. I would not be getting into this one at this time. Caterpillar looks pretty strong still. Look at that nice strong uptrend, even though it was down 0.19%. Here's the weekly chart. This one I like because it's broken through that level of resistance there, 418.50, based on that prior high. So Caterpillar looking very bullish. Annett, Arista Networks, technology sector, computer systems. That one looks pretty good. You can see that price is above the cloud on the weekly chart and the moving averages here. The single span A hasn't crossed above single span B yet, the light colored blue line. On the daily chart, very strong uptrend. I like what I'm seeing with Arista Networks. Cisco looks pretty good. Now, Cisco did pull back a bit, down 1.12%, but look, it found support right there at the Kijun-sen, the 26 period moving average. We could get a pop-up tomorrow, possibly. Here's the weekly chart. It's pulled back a little bit, but still at a healthy part of the chart here, where it's above the Tenkan-sen, Kijun-sen. Okay, we don't see major weakness here. Wynn Resorts on the weekly chart, looking pretty good. It's a bit extended also above the moving averages here, but I like the fact that it also broke these levels. Okay, do you see that right there? So we have a nice little trend line that was broken, and it's staying above it. It looks like it's going to continue to the upside. We'll see. Now, here are some stocks that don't meet all the criteria that I look for personally, so I wouldn't be pushing these ones or recommending these here. AppLovin, for example, currently in between the two moving averages. So on the weekly chart and on the daily chart, it's inside the cloud. And one of the rules of Ichimoku is you don't want to add positions when price is inside the Ichimoku cloud. Adobe, it shows basically that there's no true strong trend, uptrend there on the daily. Adobe, on the other hand, is under the cloud, so that's a bearish trend line. And if you look closely at the weekly chart, we're in a downward channel here that is continuing to the downside. It was down 0.34%. Spotify. Now here's one where Joe Terranova, that was back on April 15th. He recommended this one. This one's pulled back a little bit, showing a little strength. Now this is the weekly chart that we're looking at. Here's the daily chart, bouncing off the cloud. Would I be adding here? No. We've got a faster moving average under the slower one here. Okay, Chico Spin is underpriced. Why take that risk, basically? HIG is inside the cloud right now, down 1.71%. No on this one, too. That's the Hartford Insurance Group. AstraZeneca, okay, it came close to this prior high, and then you can see it pulled back down, finding support right at the cloud. There's Tenkinson, and there's the 200-day, that dotted yellow line. Here's the weekly chart. It's still inside the cloud. No on AstraZeneca. What about Procter & Gamble? Well, it's found some support right at the 200-day on the weekly chart. Okay, we can see that, but it's still under the cloud and still under the moving averages on the weekly. Here it is on the daily, same thing. No on PG. What about UNH? United Health Group. Look at that downward channel. Well, it's not looking very bullish here. Let me just draw that channel so you can see what I'm talking about right there. It's a tight little downward channel right there. And look, if it breaks under that low as well, there's going to be trouble for UNH. Not something I'd be interested in. I can tell you that. Here's a weekly chart too. All right, it looks like it's bottoming out, but it could potentially continue its way down. All right, and then finally PSX here is the Phillips 66, energy sector, oil and gas refining marketing. Now, this specific stock is in a sector that is not particularly strong right now, energy, although today energy was up, okay, but overall, if you look at the recent performance, most of the energy stocks have not performed that great. Here it is, weekly chart. We're inside the cloud. On the daily chart, yes, it popped back above the moving averages, but we do have the faster one under the slower one. So everything looks good on the daily, except for the fact that we had a crossover, a negative crossover, the 9 under the 24. I'm sorry, 9 under the 26. So, and on the weekly chart, it doesn't look good either because it's inside the cloud. It needs to prove itself, basically. And then let's take a look at the Mag 7. We're going to look at these three stocks. Tesla, here it is on the weekly chart, still stuck inside the cloud. Nothing to do here on the weekly. On the daily chart, still faster moving average under the slower one, but it got back above the Kijun-sen and the 200 again, up 3.02%. We're still under that trend line though. So it's a no-go there for Tesla. Apple on the daily chart is above the Ichimoku cloud. It's above the Tenkinson and Kijun-sen, but you can see that 200-day moving average sloping downwards, and it's going to hit it soon. We're about, let's see, how far are we from the 219 level? We're about 2.8% away. And how far are we from, see that long trend line right there? We are about, I would say about 5% away until we break through that. So you're taking a chance here. Here's the weekly chart on Apple inside the cloud. Nothing exciting happening here. And Meta, same thing. It's kind of like on the weekly chart, it's just going sideways. It does look bullish overall with price above the Tenkinson Kijun-sen, and the cloud is bullish in the future here. But if you look at the daily chart, we had a recent crossover here. The Tenkinson crossing under the Kijun-sen, that's a bearish sign. But price is holding above the two moving averages. So we're getting mixed signals on the daily here. So I would not be adding a position here at this level. If you're holding the position, it's certainly still valid to hold this position because it's showing a little bit of strength here too. Guys, that's going to do it for this video. Now, if you happen to like this software, okay, it's called TC2000. It's so great. Why? Because you can create a watch list, okay? You can create personal watch lists, call it whatever you want, and then add whatever stocks you want into it. You know, hypothetically, let's say I wanted to look at Citigroup, okay? So I type in C, and there it is. There's Citigroup, all right? Or maybe I want to look at Roku. Let's take a look at Roku. You just type it in and it pops right up very quickly. And you know, you can set it up exactly like how I have it here with the Ichimoku indicator, with this directional movement index. All the settings that I have, you can do that too. Now, how can you do that? You just go to my homepage here. Let's go to the Blue Cloud Trading homepage. And under this section where it says 9 more links, you click on that. You scroll down. Okay, and then there's the TC2000 chart layout. Okay, but before you do this, you may want to first take advantage and get the $25 coupon. So you click on this link here for tc2000.com, and then you basically /download /Blue Cloud Trading, and then basically from here it's going to bring you to this page. And from here, what you do is you just put your email address in this little box. Then you can download it for TC2000. If you have a Mac or Apple MacBook Pro, then you might need to download Parallels to get the actual downloadable version of this software, or you can use the web-based version if you don't have a Windows machine. There's also like an actual phone app that you can download for TC2000, which I use quite a bit. So that's another cool thing. And then here's the pricing for the software. And so there are actually 3 levels. There's the silver, the gold, and the platinum. Now the silver is really bare bones. You're only going to be able to create, you know, the layouts and watch lists. You can see that. That's the only thing you can do with silver, and that's $9.99 a month. So you can actually use this for a couple of months for free. But I would recommend going with the gold. And the reason I recommend that, even though it's $29.99, and you'd have to pay $5 out of your pocket on that, you know, basically what you wanted, what this will give you is the ability to create conditions, okay, in step-by-step wizard. You can monitor and watch trending stocks 24/7 here, draw on charts using large tool sets like trend lines. You can only draw trend lines on the gold version. Okay, there's a lot of cool things here. You can drill down through the sectors and industries like I do in my members video every weekend. You can track up to 100 alerts under gold. And by the way, if you really are into trading, the platinum is great too, because even though it's a bit more expensive, if you do the biannual here, it can bring down the price a bit from $59.99 to $44.99. Now, if you scroll down, you see the additional things that you get under platinum. So I use platinum. But if you're just starting out, the gold is a good place to start. Now, and under the platinum, you also get a $300 discount per year if you open a brokerage account through them. All right, and then yeah, so this, you can also get up to 1,000 alerts with the platinum, and there's a bunch of other things that you can do here too. And you can have real-time access to the indices, options, whatever you're into. If you want to have Bloomberg videos pop up on your screen, that's possible. There's a whole bunch of things that you can do. Anyway, guys, also one more thing. If you want to get access to the members only video, I posted another one this last weekend, July 25th. And this was for the week ending July 25th, where I went over my entire portfolio. It's a 55-minute video. And in order to access that, you just basically hit the subscribe plus button to join, okay? Or you can click on the video, and that will bring you to the Blue Cloud. What happens is you, once you've clicked on it, this is what happens. You get this little screen. You would need to become a Blue Cloud Trader level to get those exclusive member-only videos, or Blue Cloud Legend level member. Under Blue Cloud Legend level member, you also get the daily trade updates that I post. Okay, and those posts, you'd find them right next to this tab here. Once you become a member, it will pop up and you'll see this. It will say membership. That's where you find those daily posts. All right. What else? And that's where I basically share what trades I'm entering, which ones I'm closing out of each day. I also share the results from my Blue Cloud scanner, which shows some great opportunities that look good on the weekly and daily time frames. And that's it, folks. Thanks for watching. I appreciate all of you. Let's, have a great rest of the summer, and I'll catch you all in the next video.